Hello. Um, this is a additional video to show you how to calculate the year-to-date return on your portfolio. These are my stocks: IBM, Procter & Gamble, DuPont, Home Depot, and MasterCard. Um, this is my Sharp Optimal Portfolio weights. To create a new sheet, you're just going to click on that button right there. So there's your new sheet. Get rid of these old ones. The best way to get your weights and everything in, I'm going to do my target beta. So this is my targeted beta portfolio. I have my Sharp Optimal, targeted beta, and minimum variance. So we just want to say this is equal to, come over here to our Sharp, our targeted beta portfolio, click on where we have stocks. We'll go ahead and drag this guy over, and then go ahead and drag it down. We don't need the zeros, and we don't need those sums. And we want to make these guys into percentages. Add a couple of points. Add our lines in so that everything is nice and neat. Alright, let's go over how to get our data. I've done 3 stocks already. I'm going to do Home Depot and MA. I've already come here. We'll just go back. We'll do Home Depot. So we'll type in our ticker symbol HD, and this is on the Yahoo Finance website. And we're interested in our historical prices. And we want to come from January 2nd of 2014 through September 10th. Remember, it's always the 10th. Click on our Get Prices. This is our Home Depot. We're going to go ahead and download those to a spreadsheet. Just open it with Excel. And here's our spreadsheet. So we're always going to work with our adjusted close price. These are just dates. So this is 9/10, which is what we're interested in. Click here, Control C to copy. Come back to your portfolio, and that is the ending price, right? So that's the most recent price that we're interested in. We'll come back here. You notice that this is on line 2. Go down to the bottom. We're at 175, so that means there are 174 trading days. We're going to Control C, copy this one, and come back and Control V to paste it. And then our return equation, double click here, is just the ending price minus the beginning price in parentheses divided by the beginning price. So I already have that equation put in. We're just going to go ahead and drag it down one. So our Home Depot return so far has been 10.64. As I mentioned, there's 174 trading days so far. There's 252 in a year. So percentage of year that we've gone through so far is 69.05, right? Which is simply 174 divided by 252. We're going to use this number to calculate our expected return to date. Remember, this one here, that return is the year to date, so the 174 is already included here. Let's do the final one, which is MA. Just go ahead and exit. We don't need to save it. Come back to Yahoo Finance. Go to our new ticker, MA, MasterCard. And our historic prices again. And January 2nd of 2014 through September 10th of 2014. Go ahead and get prices. Download to a spreadsheet. Open with Excel. Our date. This is our adjusted close that we're interested in. That includes dividends. Control C. Come back to our Sharp Optimal portfolio. That's the ending price. Control V. Back here, we go down to the bottom. Our ending price, Control C. Our beginning price. Drag our equation down one more. Just going to go ahead and add my bottom. So it's nice and clean. So I have our beginning price, our ending price, and the return. You notice that the expected return of MasterCard based on the capital asset pricing model was 7.54%. The actual return year to date was minus 7.2. So we're obviously significantly off. Let's look at our contribution here. So we have 5%. Our contribution is our, I'll give you the equation, but it's our weight times the expected return. This is an annual amount. So our expected return, our YTD year-to-date expected return is then going to equal the contribution of our year multiplied by the percentage of year that we went through. We hit F4 to lock that in because we're always going to use the same percentage of year. And what's going on here is it's adding a bunch of extra decimal places to it that we obviously don't want. So let's just highlight that cell, right click and come here to format cells, percentage. We want 2 decimal places. We're good to go. Just drag this guy down, and here this should be equal to the sum of all of our returns. And with parentheses. So year to date we would expect a return of, our expected return for the portfolio was 8.72. The actual return for the portfolio is going to equal our weight multiplied by the actual return year to date. So this is already, this number right here already has the 174 embedded in it. We'll hit return and come back to our format cells, and we just want 2 decimal places. And we'll drag that one down. And we want to equal the sum of everybody. So our expected return for our Sharp Optimal portfolio was 8.72%. Our actual return was in fact 3.74%. So our portfolio, our Sharp Optimal portfolio, is underperforming what our expectation is. So here's our targeted beta portfolio, and I picked a beta of 1.1. Alright, so I should get 1.1 times the market return. Come back to our year-to-date returns. Again, our expected return, we can just actually grab both of these guys and Control C and come down here and Control V to paste them. So our equation here is set. It's 0.33% per year times the percentage of the year. So in our minimum variance portfolio, 2 decimal places. In our minimum variance, in our targeted beta portfolio, our expected return for the year would have been 7.58%. We need to do a little correction here to get our equation looking correctly. This D13 is not what we want. It is in fact our return contribution so far for the year. And we want just 2 decimal places. Why Excel does that, I don't know. And we'll drag this one down. Alright. Get rid of our borders, add our bottom border back in, and our sum still works. So again, our expected return for the portfolio was in fact 7.58. The reality was that it was only 3.9. This is based on the targeted beta portfolio. Okay, and then you'll do on your own the work for the minimum variance portfolio. You can see here in the minimum variance portfolio, we had less weighting on DuPont and more weighting on IBM and Procter & Gamble. So for my portfolio, what it looks like is that I'm going to end up with the best performing, in actuality, the best performing portfolio was the minimum variance rather than the sharp optimal portfolio. But, so what you want to do is compare and contrast the expected value of your portfolio versus the actual return of your portfolio. Explain why it happened. In my instance, the main driver here is the fact that I had a much lower than expected return. I expected to get 6.3% return out of DuPont. I actually only got 2.49. IBM and Procter & Gamble overperformed. Home Depot overperformed, but I had one stock, which was MasterCard, that woefully underperformed my expectation. And I had a fair amount of weight on that particular stock. So that's the kind of thing that you want to go through and precisely and quickly define. Thank you very much. If watch the video multiple times, make sure that you're clicking on the buttons correctly. And remember, you should be having the same number of days, 174, that I have in your data download. We're going only to September 10th. Make sure you change both variables. Thanks a lot.